Hello everyone, welcome to Kautilya IBS Mumbai. Today we will be exploring about debt market and fixed income securities, unraveling how they work and why are they important. Imagine you lend money to your friend and you expect them to pay you back with interest, right? That's the basic idea behind the debt market. Here, governments and companies borrow money from investors like you and me by issuing fixed income securities. These securities act like loan agreement. They promise a fixed interest rate, like your friends promise to pay back with extra on top. These interest is typically paid out regularly until a set date when you get your original investment back. There are two main types of debt market based on how long the borrower needs the money for. The money market, which is for short-term loans, usually less than a year, and the capital market, which is for long-term loans, usually more than a year. Now we will be looking at the difference between money market instrument and capital market instrument. In money market instrument, maturity is less than a year, whereas in case of capital market instrument, it is more than a year. In money market instrument, risk is lower, whereas in capital market instrument, risk is higher. Liquidity is high in case of money market instrument, whereas capital market instrument have less liquidity. Example of money market instrument are treasury bills, certificate of deposit, commercial paper. Example of capital market instruments are equities like stocks, debt securities like bonds and debentures, derivatives such as options and futures.
Now, let us look at the macroeconomic factors impacting debt market and the performance of fixed income securities. Inflation. The general rise in prices erodes the purchasing power of future fixed interest payments from bonds. So, when inflation is high, investors may demand higher yields on new bonds to compensate for the loss in purchasing power. This can push down the price of existing bonds with lower fixed rates. Economic growth is another important factor. A strong and growing economy typically leads to lower credit risk for borrowers, both companies and governments. This can translate to lower yields on new bonds as investors perceive them as less risky. Conversely, a weak economy raises concerns about defaults, potentially pushing yields up and bond prices down. Government fiscal policy is another important factor impacting the debt market, as government spending and tax policies can impact the debt market. High government deficits may lead to increased government borrowing, putting upward pressure on interest rates and potentially affecting bond prices. The health of the global economy is another important factor, as it can influence the debt market. Events like recessions or financial crises in other countries can create risk aversion among investors, leading them to seek the perceived safety of government bonds. This increased demand can push bond prices up and yields down. Regulatory and policy changes are another important factor, as changes in regulations or government policies can impact the debt market. For example, new banking regulations might affect the supply of credit, influencing interest rates and bond prices. If you like the content, do like, comment, share, and subscribe to our YouTube channel, Kautilya IBS Mumbai.